Start recording. You know the timing. The timing gonna be from this one. We can have like a 10 minutes break after after 20 past 3, and then we can have 20 minutes break after 10 past 4, and then we're gonna resume and we will cover that 10 minutes right here. Okay. And I already talked with the administration, so everything is fine. And most of you guys are also willing to accept this timing, so everything is fine. So now onward, just note down the timings. Let's start. Previously, in finance for international business series, we came across the basic definition of finance. Financial environment. We talked about financial environment, financial institutions, financial markets, investments, and management. And finally, we also talked about the entrepreneur versus personal finance. Hope you all knew about these basic concepts of finance. Further, we revealed that why finance is relevant, that is to make economic decisions, mainly economic decisions, and then personal and business decisions as well. So at a company level, at a government level, it's an economic decisions which finance can help out to make. And at individual and business level, certainly there are some important decisions to make. So main theme of learning the techniques of finance and like different methodologies in finance to analyze the financial, to analyze any problem, any issues, any. We will talk about that. What are the issues involved in finance? Because all the issues are basically gonna start with the deficiency of money or something related to it. Always remember, right? So you know what is finance, you know how relevant finance in daily life. Without finance, your life status will be nothing in your society, right? When we touch the principle of finance, we learned that it is based on four important pillars. Number one, value of money, which is very important. We talked about a lot about this value of money in last lesson. Again, we talked about returns on our investment, especially with linked with risk. So risk versus return, there is going to be high risk, there we will get high return, there will be low risk. It's linked with different investment to different assets, we will get like the low return. Then to minimize the risk factor, we learned about that there is really important to diversify your investment. Which means also to make a portfolio investment so that if you are facing loss from one assets, you can compensate or minimize your loss from the return to from the other assets you have already invested. And then we also talked about the financial market, a very important and very basic pillar of financial market. If there is no market, remember, if there is no market, you cannot sell. You cannot buy, you cannot trade, you cannot generate the money, right? So it's really to have a good and strong financial market in the country or in an economy or in any state. We also touched about the management and ownership conflict. Last but not least, moral hazard is there. For example, if someone wants to commit fraud and forgery by using financial means, there are some loopholes, there are some chances that they can do that, but not for a long time. They can easily get captured if they do that by the relevant authorities. Then we talked about different characteristics and components of financial system. What are the main components of financial system? Is that first thing, that relevant authorities means policymakers, right?
Who are the policymakers? Mostly central bank. Central bank means one main bank in the country who regulates the law, who regulates the activity in the financial market. So central bank, I just wrote CB, as a authority which regulates the laws regarding finance in an economy. That's the central bank. So that's the role of the policy. So policymaker sits here. We're gonna decide that, okay, what is the money supply, how we in term, and then of course then it brings the whole monetary system. So the policymakers started with the monetary system. Monetary system is a system where all the paper money and paper money is being issued and created and transferred to other financial institutions. So it means then there comes the financial institutions. So what does financial institution do? Anybody remember? Yeah, their main theme is to collect the money from the savers, collect from savers, and lend it to investors. How? That's what we're gonna learn today. So that's the main theme of financial institutions. So they are like policymakers first, then monetary system, then financial institution and financial market. Financial market is a place where market assets, where assets are being marketed and they are being sold and bought. Means tradable. The trading goes in the financial market. So of course, these four are really important components of finance. And then we talked about further that how many kinds of financial markets. Do you remember how many kinds of financial markets? Anyone? Almost there are like 6 or 7 financial kinds of financial markets, right? We talked in detail about these markets. Money market, money market. What is money market? Where we sell short-term securities, right? Short term means less than 1 year. So any security which matures less than 1 year, we deal it in a money market. Then there is capital market. Vice versa, any security which is more than a year, more than in 1 year, that we trade or we deal with that security in a capital market. Right? And then we talked about the primary market. Primary market is a market where the security is first time launched by any business firm or any company to get the money to borrow the money from the public. And secondary market is a market where it's retradable and this hence generating a lot amount of investment from the same security. Then we talked about the debt securities that we, for example, if somebody wanna get loan to build a house, then mortgage securities are under the same market, right? So bond market, debt security market, mortgage markets, equity markets, derivative markets, and lastly foreign exchange markets. So we have discussed in details all about this in last lesson. So hope that you have read, you have gone through the book chapter and had more insight of this thing. So this all we already have covered. Now remember one thing, all the markets deal with two important things. One, any market, right? Any kind of financial market, they deal with two important things. One, investments. If there is no investment going on in a market, that's not a financial market, okay? So, and number two, trading. Trading to enhance the same investment. So first investment is being carried out through issuing the securities and notes and many things, right? So many tools, financial tools, which we discussed last week, and then to trade them. It's the same thing. Like you buy a you buy a house for 1 million RMB, right? Just an example. 1 million RMB, you bought a house. Now you sold it to your friend or anybody, any other person for 1.2 million. Now, zero point 0.2 million is your return on that house. So your house actually generated this much amount of money, which you can further invest and to buy a car or something like that. But then that guy will sell this 1.2 to maybe 1.6 million after a year. So now that zero point 0.2 generated further 0.4 million. And then after maybe 6 years, that guy will sell out into 2 million. So look, the worth of the house when it started was the same, 1 million, right? But it generated an extra 1 million to reach at the 2 million. So that's the benefit of trading. So in trading, you create the money. When you transfer money from one hand to another hand, you actually are creating the money. So individuals, we all do that when we are circulating money through our hands to one from one place to another place. So of course this profit will be this return will be distributed among different players, that's for sure. But it the main theme of the financial market or any market is to generate the financial activity or or the money, right? Now, today we will see the main features and activities in the money market. So we will talk about the money market mainly. What are the tools? How does it function? How and why? Why do we need money market? Why does it function like in such a way? All these things we gonna learn today. Okay, but first we will learn a little bit about problem, as I told you, economic problems or economic issues. Let's see that any problem in our life, is it really because of the reason apparently we see, or it finally ends up to finance in most of the cases? What do you think? In your life, you will have many problems, right? Sometimes you don't talk to your friend. Sometimes some friend didn't go. Any kind of friend, any kind of. Sometimes you have a problem with your parents. Sometimes you have a problem with your teacher. Sometimes, so there are many problems. So apparently, you must be thinking, no, why teacher is saying that we have all the problem because of the finances. Now, is it true or not? What's your intake? Tell me. I need your feedback. Are all the problems, you can tell me on the messenger, that are all the problem we are facing, or most of the problem we are facing, are due to the financial problems or not? What's your intake? Can somebody tell me? No? Well, apparently when you see, the problem leads to the apparent reason. But let's say you have a problem with the teacher, right? That you cannot understand teacher, right? For example, you have a problem with me. I'm just taking example. Maybe it's true, maybe it's not true. If it's true, you should tell me first, okay? So that I can solve this problem. So apparently you think that okay, it has nothing to do with the finance. But if you dig deep, and you will see why you don't understand the teacher, because look, what did you do? You have invested your money in education, right? And you are not getting the same return. That's why you feel angry. If you have not invested money in the in teaching, in education, then if you don't understand teacher, you wouldn't mind that much, right? You will mind, but you wouldn't mind that much. How you mind when when you have given the money and you're not learning anything. So then you say, oh, okay, I don't like this teacher because he doesn't teach well or she doesn't teach well. So I want to change this teacher, blah, 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 blah. Right? So many reasons you will come up. But these are the apparent reasons. These are not the actual reasons. So actual reason was, again, the money. You are not getting the proper benefit from the money you have invested, right? So similar thing, it happens in a family. Like when you are having a problem, when you fight with your parents or something, behind the scene there is a problem of finance, maybe not for you but on the other side. For example, if you're fighting with your father is like also fighting with you or arguing with you, so behind there must be some financial problem. So most of the cases the problems are based on financial problems. Do you understand that? And similar thing happens with economic crisis. So apparently, we say that economic crisis, it depends. It is being made. Remember that investment is not only for the money. Investment is also for the time, and actually, time is a value of money, right? Our money is a value of time, vice versa. So this is really important. When we talk about economic crisis, for sure, they can be caused because of the imbalances of the finance. Let's not get into philosophy that what are the imbalances or what are the drawbacks of the policies, and hold here and just take an example of 2000 of examples. Oops, why it's like this? I really hate that I have to turn on this again and again, but it's convenient for me. So I'm ready to do that. So so you know what is crisis, right? So every crisis, there is money involved behind every crisis. We're gonna take a look into two Great Depression of 20th century and 21st century. Great Depression, and it happened in Europe in 1934 or something like near to 1933, 1934. It started in 1930. And the recent Great Recession of 2007, 2008 in US. First, it started in US and then it spread it out in the rest of the world. How? Through financial institution. So that's why you guys are really important, because people really rely, or investor really rely on your expert opinion. So you need to understand this concept really well. Now, if we see 20th century, the Great Depression, and then we have 21st century recession, and some researchers, some experts, they say that this 21st century recession was even more severe than the 20th century depression. What initiated these two recessions? What initiated the Great Depression? Do you understand? Anything, any possible reason? And what initiated these? If you go back and you see both the recession and you analyze both the depressions, you will not be amazed to find out the movement of prices are behind this. So the prices, changes in prices, variation in prices caused these two recessions, these two depression. In Great Depression, there was a change, sudden change in gold prices, because after World War One, the gold prices really went high. So when the World War One was over, the authorities, they decided together that they had to bring down the gold prices to the level where it was in World War One, before World War One, before World War One. Now, sudden decline in gold prices affects a lot to the economy, because at that time the money was not paper money in most of the countries, and there were not so many countries, by the way, that by that time mostly they were colonies. But in most of the countries the gold is a coin, right? It is used as a money. So certain decline in gold prices means you are declining the value of money, which means they will be hard. It is hard to get employed in different industries, in different sector, agriculture sector, industrial sector, service sectors. They're not gonna pay you, or whatever they will gonna pay you, you're not gonna buy enough thing to survive. So mostly that this caused the unemployment during that time. And in Europe, a person with the bag full of money bring brought that bag to a bakery to buy one loaf of bread. So that's how it impacted the prices, impacted the economy, and it started. It declined the value of money, and the Great Depression has started and hit the most of the countries. Same thing happened. Same thing happened in 2007 and 8. So here it was gold price. Can you imagine what was the reason here? It was a house price, real estate price. House price means real estate. Now, what happened actually in 2006? There was a sudden boom in house prices. Why? We will see. Then we will find out that who was the culprit behind the both the depressions. Um, so 1934 depression, we know that it was triggered because of the gold prices, decline in gold prices. And in 2007, 2009 crisis, it was the housing price in US. So a rapid decline in house price led the unemployment. In first, in the construction industry, and had had to lose their jobs, who are working in a construction. But it only affected the construction industry. So why we are blaming that it caused the whole economy, our whole financial system, to reach at a point where it can be collapsed? Can you tell me? No? Let me see if you're answering or not. Yeah, you're answering me. Sorry. Um, okay. Because first, so the oh, uh, so what do you think? Bad policy or money problem? As I told you, because it's prices, so it's gonna be money problem. So what is the so what did how did it happen? So first, the construction industry, it hit the construction industry, the low prices, the low house prices, or housing prices, right? Second, that means we have to figure out what happened, how did it affect the next level. So this is the construction industry, right? This is a construction, that how it hit the rest of the sectors in an economy. So these are the rest of the sector, in which financial is one, and the other sectors are also. Then for that we need to see the relation between prices and employees. What is the relation? If prices goes down, means there are not so much demand, so not so much supply, so employees gonna lose their job, and that's how the construction happened. So what are the reason behind the low prices? The reason was mainly the authorities. The authorities decided, they brought some law, some financial law, which encouraged the households to own their own houses rather than to live on a rent. So they launched different schemes. basically get the uh, to lend the money. So prices led the unemployment first in construction industry, which affected the mortgage. Now many people they have borrowed money through mortgage securities. You know mortgage securities, right? To take the personal loan, you need to issue a mortgage security. Market security is simply like if you want to get loan, you will have to give me a piece of paper where you will tell me that this land belongs to me, and if I am unable to give your money, so this land will be yours. Now imagine that you have given me a piece of paper where you stated that your land worth 1 million RMB, and on the face of 1 million, I give you the loan of, let's say, 0.7 million RMB, right? Now, suddenly the prices goes down. So your mortgage value is now 0.3 million. So I will definitely get the loss, right? So you're not going to pay me back. And for that, I'm going to use your mortgage to sell it. When I sell it in the market, it gives me zero point 0.3 million. And I will lose 0.45 million as a financial institutions, right? So this loss, this is only from one customer or from one side. Same thing happens if I have lend it, if I have lent it to as many customers as I can, because there was a policy, there was an encouragement from the authorities. So hence it trapped the financial institution or financial industry got trapped into the same crisis. So it trapped the financial industry. And during that time, especially when you come to me to lend, I'm a financial institution, so I'm already in a debt. So I'm using that debt to invest in you so that I can get, because I have issued the debt securities and I'm already in debt. Remember, I'm a financial institution, right? I'm in debt because there was a government policy announced. So they encourage the housing ownership. Look, government encourages housing ownership. I'm a business person, right? So I know people gonna buy houses. For that, they need finances. So I'm a financial institution, one financial firm. What do? I issue I issue debt security and created the money and get the finances. So it means I'm in debt, and then you come to me. I I get mortgage security from you, and I give you the loan. Now you are unable to repay me because the price is declined. You're unable to give me, which means I need to sell your mortgage security in the market. The mortgage was 1 million before, but when I sold, it's zero point 0.3 million. So I have already a debt of, let's say, 2 billion. So in that 2 billion, zero point 0.4 million will be added. And similarly, there are so many, that means defaulters, which will be added there. And I will be near to collapse. I will be gone. I will be destroyed. So that's a perfect situation of financial storm. So that's the financial storm. And it's almost near to a collapse. Now, if we go further behind the problem, as I told you, the rise in price in 2006 was basically based on the policy which US has made to encourage the housing and ownership. It means when everybody gonna buy a house, it means there are also some borrowers who are risky borrowers. So that increased. That increased risky borrowers, which are unable to pay, and that's how, especially when the decline in the prices, and they can easily get money from the financial institution like me who are there to generate or to create money from this opportunity. Now, when the house price declined, the value of mortgage declined as well. So there was already job loss. People were jobless. So it was really hard for them to pay. So switching job was impossible. So you cannot, it's like, for example, if I'm a teacher right here at the university. So let's say there was like a downsizing, the all the education sector got losses and they don't have money to pay, and they decided to kick all the teachers out. So what we're gonna do, we can open our own personal uh, teaching place where we can do teaching, because two professions you will never get hungry. One is teaching, right? What is the other one? Skill. So if you have a skill, you will never die hungry. And if you are a teacher, you will never die hungry, because people will definitely gonna learn, and that's learning is really important for people to get more resources, right? Financial resources. So people want to know that how to increase their financial resources. So this caused a decline in the mortgage-backed securities. So the financial sector faced losses and forced further downsized in there. So there are job loss also in the financial market. Then every business which are linked to those financial institutions, whose money was invested in those financial institutions, they also got lost, and they have to kick the employees out as well. So hence this scenario, starting from the house price, this scenario, starting from the house price, starting from the house price, it ends to the whole economy. It spread all over the economy. It's not working. So it starts from here and then it spreads to the whole economy, whole US economy, to every sector. And then it got so serious that it turned out to be a whole economic recession. And it also shifted to another country through financial institution again, through stock market. Through stock market. So what was the solution for this? Was there any solution? How did they stop? How did this stop? Like remember the 1934 depression, the 1930s depression was unable to control. That's why it led the Second World War. But if you see this financial crisis, it was really like well tackled by different experts, and then the government they bail out. So the government bail out the companies who went almost near to default, bailed out those companies. Means they launched different funds because they were having funds in reserves through tax generation. So role of financial markets is very important, right? What is the main role of the financial market? We will talk about this now later on. What is the main role of financial market? I told you many times, like since like last week and this time today, main objective of financial market, you can raise this and I can ask you here. What's what's the role what's the role of financial markets? Two important things. One, issuing money, securities, trading, and transferring. That's it. These are the roles. First, they issue, they create the money, then they launch the securities, then they trade them, and then the transfer of money. So all this is included in the financial markets role. So one important aspect is how to transfer savers money to investment. I mean, main theme is like to get the investment from the saving guys and encourage them or do whatever they want to do with the policies and convert them into investment. Why investment? We will talk about it now. First thing, how to transfer savers of the society into investors and why. Main reason, to enhance the economic activity. Like, what is the process? Transformation to enhance economic activity. Why? Because when the economic activity is upgraded, or there will be a lot of economic activities happening in the society, it gives an opportunity to society through which it can reach at a welfare stage by increasing employment, low inflation, all the like controlled macroeconomic efficiency in the variables, and just simply generating the income, because any economic activity generates income. Because money is not like money. Remember one thing: money isn't like a hen which lays egg. Money is like a blood. It circulates and it gets more. So money is like a blood in the body. And in economic system, money is like a blood, right? Just like a blood is like in the body. So the more it circulates, the more money is being generated. Just like blood, the more blood is circulated in your body, it reaches out to each and every cell of your body. The liver gonna function more and it can generate more blood. So here the liver is the financial institution, right, which creates the money, and money is the blood, and all the economic units are the activities, right? So the society really needs a good circulation of money to get to the welfare point, and for that they need more money. From where they can get money? From savers, and then change into investment, because investment means circulating of the money. You you give money to one person, then you get to another, and that's how it generates. As I gave you the example of a house, you bought the house, you sell the house, now 1 million generated another 1 million, right? At least on the numbers. This makes financial institution as an economic unit, right? Because financial institutions are there to generate money. What is the economic unit? It's a finance generator. You know, generator, right? To generate something. You have a machine, right? To generate electricity. You have a machine to generate something else, to create something else. So financial economic unit is any unit which generates finances, which generates money. As an economic unit, financial institution is a really strong economic unit. Now, if the money, because of course financial institutions also have to spend the money, right? Neither on not only gain the money, but not only create the money, but also spend the money. So if the money spent, so if the money spent is greater than the money generated, then it's a deficit. If the money spent is less than, if it's less than, then it's a surplus. Then it means you have more money to spend. So remember one again, I say again that money spent, if the money spent by the institution or any economic unit more than it's spending, for example, if a government spend money more and then it generate less, government generates the money through tax system. So if the tax revenue is less than their expenditure, so it means our government is in deficit. And if the money spent is less than its generated income, then it means greater than its generated income, then it means deficit. In Chinese case, there is a money surplus. So Chinese expenditure are less than the income they are generating through trade and through different financial transactions, right? So if you have more money in surplus, then you can invest in more projects and which can even increase further. So it's a circle. Once you achieve the surplus circle, and if you have a right policies, you can make the circle bigger, 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 and bigger. And now we're gonna wipe out the circle, and we already did that. And how to use them? Then what we do, what the as a financial institution, what I have to do, I have more room to use extra money to save or to invest. Individual can be a deficit also. Individual can also be just like financial institution. Individual person like you, like me, like any business, small business person, individual can also have a surplus or deficit. For example, if your monthly expenditure is more than your income, more than your salary, more than your scholarship money, then it means you need to lend money. You need to borrow money, right? So it means you are in deficit. But if you save more, means if you have more income than your expenditure, it means then now you have option to either to save money or to invest money. How you gonna invest? You can lend to someone else, right? That's how you can invest. Some business firms, they are surplus economic units as they choose to borrow and sell stock. So how do they get the money? How do they generate the income? As we told many, as we learned many times, that companies they sell their stocks and then they borrow the money from the market on the base of a promising note. Actually, this currency money is also paper money is also promising note. So what do? They sell the stock and they get the surplus economic. They become surplus economic unit. And then after promising you that I will give you the money with certain, why will you believe in my promise? Simple reason, return, right? I will issue you the stock that this is my company stock I will pay you this much percentage as a return, as a profit on this principal amount of money. All right, you give me 1 million, I give you a stock, I give you stocks of 1 million, worth 1 million, and I say that, okay, I also give you 6% return after every year. So this 6, you are the saver, right? But when you see this 6%, you say, oh, I'm getting 6% for my on my money, on my saved money. Okay, I will lend it to this person and I will buy this stock, right? So you bought my stock and you gave me this much money. And on that money, I promise you to give you the return and expand the, and with that 1 million, I expand my business. And when I expand my business, I earn more profit. So from more profit, I give you the 6%. So that circle really attract to you to give me your money, right? So that's how you can motivate the saver from the society into an investment. But remember one thing, greed is never ending desire, right? So sometimes saver can also lose their investment. So greed is never ending desire. It will never end. We always want more, 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 more. And this greed of money also motivate those savers of the society to give you the money. So let's have a 10 minutes break here now. You can freshen up your mind, talk about something else, something about the fashion, something about the sports, um, or just close your eyes and take a 10 minutes rest. Don't think about the finance because then your mind will be freshened up. Okay?